Good day everyone. Today I will be discussing the first half of our topic, which is financial ratio analysis and their implications to management. This is on chapter 4. To start with, ratios present relationships between two variables. Financial ratios therefore refer to the relationships between financial statement items or accounts expressed in mathematical fashion. In using these ratios, your task is to interpret them as favorable or unfavorable. To do so, you should follow some standards that would determine the favorableness or unfavorableness of the outcome. Some of the standard ratios used are based on number 1, company budget for the same period. Number 2, those used by the industry to which the firm belongs. Number 3, those used by the firm's successful competitors. Number 4, those used by the firm using prior periods. And number 5, those used by the analyst in the past. Industry ratios are averages developed by a group of experts involved in research. These empirically based ratios are used as standards in financial statements analysis. So, the results from financial ratio analysis are indicators of a firm's weakness or strength, but are not in themselves. This is understandable since the ratios spring forth from financial statements, which, as we have mentioned, are subject to limitations. Results derived from the computation of ratios could be presented as percentage, a fraction, a peso amount, or a relative ratio. So, to illustrate, let us use the figures of real corporation in chapter 3 that I am showing you right now. Please do give an attention for this illustration because my whole report will refer to these figures. What I am showing you right now is the comparative income statements of Real Corporation for the period ending December 31, 2015 and 2014. So in this illustration, it shows the sales of the current year and the previous year, which is 2015 and 2014, less the cost of goods sold that will result to the gross profit of the company for 2014 and 2015. So add the selling expenses and administrative expenses to get the total operating expenses. Then the total operating expenses will be less or deducted from the gross profit, and it will result for the operating income, which is 220,367 for 2015 and 209,847 for 2014. So from this amount, you have to less the interest expense, which is 41,860 for 2015, for example. Then it will result for the net income before taxes of 178,507, and then less again the income tax, since this amount is before the taxes. So less the income tax, which is 22,477, it will result for the net income that is after taxes, which is 116,030 for the 2015 and 107,862 for 2014. Assume further that Real Corporation is a leading department store of fashionable clothes and apparels, with 5 strategic branches located in the metro. In this example, the authors provided the computation of the ratios for the current year. You are tasked to compute the ratio for the previous year. So in doing the analysis, we shall cover the company status in terms of first, liquidity. Liquidity pertains to the firm's ability to pay any immediate and incoming cash disbursements. Number 2, asset utilization. This measures how often is the turnover of accounts receivable, inventory, and long-term assets. Number 3, debt utilization or leverage, estimates the overall debt status of the firm in light of its asset base and earning power. Number 4, profitability of the company. Profitability, this measures a firm's capacity to earn sufficient return on sale, total assets, and owner's investments. So now let us refer to the illustration that I have given before. First, in liquidity or short-term solvency. Number 1, current ratio. In 2015, so refer to the illustration. The formula is current assets of 870,838. That is the figure in the illustration that I have shown you before over current liabilities of 390,508 pesos. So the total is 2.23:1 or 223%. So the interpretation here is for every 1 peso of current liability, the company has 2.23 pesos current assets to pay it. It indicates that the real company is able to pay their current maturing debts with 1.23 pesos to spare for every 1 pesos of liability they have. So to our task to solve for the 2014, so the current asset for 2014 is 792,309 over the current liability for the 2014, which is 336,159, equals 2.36:1, or that is 236%. So it is important to remember that no one current ratio is applicable or appropriate for all business. Others may consider a ratio of 1:1 as satisfactory. A high current ratio does not necessarily mean that the company is able to meet current maturing debts, because the firm's current asset is composed mainly of inventories, and inventory is considered as a slow-moving asset in terms of its convertibility into cash. Another asset that some analysts do not use in the computation of current ratio is prepaid expense. The reason is because they are not sources of cash. It represents the consumption or use of future benefits like prepaid rent or prepaid advertisement. Consumption of this does not entail cash inflow but recognition of expense for the company. So a current ratio with significant amount of prepaid expenses may not necessarily mean that the firm is capable of paying current maturing obligations. Upward and downward movement of current ratio. So A, increase in current assets or decrease in current liabilities increases the current ratio. So here, the increase in current assets is 10,000. So from 50,000 plus the increase of 10,000, so now it is 60,000. It states here that increase in current assets increases the current ratio. From 2:1, it is now 2:4:1 increase. On the other hand, here, it says that decrease in current liabilities increases the current ratio also. So the decrease in current liability here is 10,000. So from the total current liabilities of 25,000, it is now only 15,000. So from 2:1, it is now 3:3:1. So, in letter B, if the previous current ratio is 1:1 and there is an increase or decrease of the same amount on both the total current assets and the total current liabilities, it shall have no effect on the new current ratio. So, illustrated here, the total current asset is 50,000. So, there is an increase of 10,000. The new total current assets now is 60,000. Same thing with the total current liabilities with an amount of 50,000 and an increase of 10,000, so it is now 60,000. Because it is stated here that if there is an increase or decrease of the same amount on both the total current assets and the total current liabilities, it shall have no effect on the new current ratio. So here, the current ratio is 1:1, and after the increase of 10,000 on both the total current assets and total current liabilities, it is still 1:1. On letter C, previous current ratio is positive, increased by the same amount in both total current assets and total current liabilities, so the ratio shall decrease and vice versa. So in letter C, previous current ratio is positive, increased by the same amount in both total current assets and total current liabilities. Ratio shall decrease and vice versa. So in the illustration here, we have a total current assets of 50,000, then an increase of 10,000. So now the new current total asset is 60,000. On the total current liabilities, we have here 25,000 with an increase of 10,000, so a total of 35,000. So as stated here, if there is an increase on the same amount on both the total current assets and total current liabilities, the ratio shall decrease and vice versa. So with a positive ratio of 2:1, when you say current positive ratio, it means that the current assets is more than the current liabilities. So from 2:1, it becomes now 1.71:1. So it decreases.